I'm Kara Murphy, and this is Money with Murphy. In the second quarter, if you had taken the Rip Van Winkle approach to investing and slept through the whole quarter, you would have woken up at the end of June feeling pretty good about your portfolio. After all, U.S. stocks reached new all-time highs and bonds gained ground. But if you're like most people who followed the headlines and the dramatic moves in the market, your experience was quite different. In April, tariff announcements drove stocks down an eye-popping 19% in just a few short weeks. Then, once tariffs were paused, the market rebounded sharply, with the S&P 500 gaining nearly 10% in a single day. That was the third highest one-day gain in the history of the index. From trough to peak, the market gained 23%, a spectacular turnaround, and the second fastest recovery for U.S. stocks in the last 75 years. It was a reminder to investors to stay focused on the long term and that diversification matters. Despite the turnaround, though, U.S. equities still lag international equities year to date, with developed international stocks ending the first half of the year up 19% and emerging market equities up 15%. At the sector level in the S&P 500, performance is nearly a complete reversal from what we saw in the first quarter. Technology gained nearly 21%, reversing its quarter decline of 13%, ending the first half of the year up 8%. On the other hand, defensive stocks like consumer staples, which led in the first quarter, rose just 1% in the second quarter. Nearly every sector ended the first half of the year in positive territory, with the exception of healthcare and consumer discretionary stocks. Bonds, too, went on a wild ride in the quarter, driven by uncertainty around tariffs. After the tariff announcement, the yield on the 10-year Treasury bond briefly dropped below 4% as investors sought safety, before then reversing direction up 30 basis points in just 4 trading days. That was the sharpest rise since 2008. Despite the volatility, the yield on the 10-year ended the quarter exactly where it began, and the Bloomberg Bond Index closed June up 4% for the year. So for bonds, too, the Rip Van Winkle approach was the right one. But the U.S. dollar had its own challenges. After starting the year strong, the currency then swiftly declined. Continued policy uncertainty, volatility, a weaker dollar led some investors to question the preeminence of U.S. markets. Yet there's a silver lining. A weaker dollar can help boost U.S. exports, potentially aiding economic growth. Now, risks remain elevated even as the market hits new highs. Inflation is above the Fed's 2% target. Job growth remains healthy. That allows the Fed to keep rates higher for longer. The market currently expects about 2 cuts by the end of the year. Meanwhile, trade remains a wild card, and of course, tariffs continue to loom. While deals have been made with the UK and Vietnam, the United States continues to negotiate with other trading partners such as the European Union, China, and India. The administration's tariff pause will likely soon end. In addition to those negotiations, the White House and Congress approved a budget bill that will introduce spending cuts, tax cuts, lower regulations, and a higher debt ceiling. As we head into the second half of the year, one key theme is clear: diversification is back. Market performance has varied across asset classes, countries, and a well-diversified portfolio can help cushion against those risks while capturing opportunities. So thanks for watching, and as always, invest wisely and live richly.